Goldman Sachs is reportedly no longer bearish and has declared that the market bottom is already behind us.
If saying it would only make it so.
Hey everyone, my name is Jack, and in this video I want to talk about Goldman Sachs's their bold prediction that this is the bottom of the market, and why they think that, what they're doing about it, and what this means for you. But before moving any further, a friendly reminder that this video is not financial advice. I am not a financial advisor. I'm just some guy on YouTube giving my perspective about stuff. If you like it, please caress the like button just this one time. It lets me know that you like this sort of content and lets YouTube know to push it to other friendly people. Let's get to today's, well, I should say yesterday's, juicy prediction by Goldman Sachs. For those of you who don't know, Goldman Sachs is a gigantic investment bank that has, 1.5 trillion in assets under management. Needless to say, their analysts and their investors play a sizable role in the financial markets, so it's potentially worth listening to what they have to say. The Goldman team has stated that their S&P 500 end-of-the-year target is $3,000, which is about 8% higher than where it currently stands at about $2,750. And they think that the worst of the market rout is behind us. This is in stark contrast to their dire predictions from a month ago, where they predicted that the S&P would decline to $2,000 following a brutal upcoming earnings season. The unprecedented speed of business erosion was driving the markets down rapidly with no signs of stopping. They jumped on the world is ending bandwagon when the markets were eventually down 30% in mid-March. But now Goldman has completely changed their position. They think that the market has hit the bottom and won't go much further down, if at all. But what about all of the terrible news that we've been getting about the pandemic, unemployment, missed rent, the growing mortgage crisis? We're seeing record numbers of people out of work, increasingly strict quarantines, and other rough news. So how on earth could we possibly be heading only up from here? Well, Goldman has pointed out that S&P bear markets usually bottom out shortly before the worst of the economic data comes out. The top axis of this chart are all of the markets that have had the market bottom out before the worst of the news came out. How could this be? Well, one explanation is that stocks have uncertainty priced into them. Leading into bad times, uncertainty is high. A great example was the month of March. Investors had no idea what impact the pandemic would have on businesses, what the government was going to do about it, and how we would potentially recover from it. Even though we don't know everything now, we do know a lot more than we did before, so arguably some uncertainty has been reduced. In this case, Goldman is assuming that the worst news might still be on the way, but that doesn't matter since it's already been priced into stocks. And maybe the market already readjusted itself during last week's historic rise following what was a terrible March. Goldman thinks that the important factors that would protect against downside risk and drive market prices up over the remainder of the year are the fact that the government has taken a very active role through the stimulus package and in flattening the pandemic curve. They think that this has reduced that downside risk significantly, enough to say that we've already seen the bottom. And they think that the efforts have been so reassuring that the S&P won't return to a bear market in the near term. Specifically, they stated, quote, "If the U.S. does not experience a second surge in infections after the economy reopens, the do-whatever-it-takes stance of policymakers means the equity market is unlikely to make new lows," end quote. Even though quarterly earnings for many firms are expected to be terrible, that's just it. They are expected to be terrible already. The next few weeks will have many companies sharing their quarterly earnings, which undoubtedly will be historically low for the vast majority of firms. Many have had their businesses shut down and have had drastic cuts to revenue, but the market already knows this, and as Goldman would suggest, has priced the bad news in already. A relevant example is JP Chase, which just announced its earnings this morning. It announced that it lost a ton of profits, with net income dropping to $2.87 billion in the first quarter of 2020, off of last year's first quarter, which was $9.18 billion. Meanwhile, JP Morgan has been shoveling billions into cash reserves to weather the coming loan storm. The news was definitely negative, at least in general, and JP Morgan seems to think the worst times are coming, given their reserve hoard. But practically nothing happened to their stock today. In fact, despite the bad news, it's up about 1% as of me recording this video, which you should definitely like, by the way, in the meantime. But that bad news has already been priced in, it seems, and if anything, investors slightly undervalued the stock leading up to earnings. seeing their actual earnings and their large amount of reserves has reduced at least some investor uncertainty, even if the news was bad. Or maybe it was relatively good news since many investors thought it was going to be worse than it actually was. So, according to Goldman Sachs, the only way forward would be up, since earnings can't be any worse than we'd expect, I suppose, but you never know with stocks. As a wise stockbroker once said,
Number one rule of Wall Street: nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in circles, least of all stockbrokers.
After all, Goldman Sachs did a survey of institutional investors about a week ago, and half of them believed that the stock market was set to go down more before recovery. So guessing which way the market will go in the short term is typically a coin flip. For all we know, the government might fail to actually roll out the stimulus checks that they've promised, at least in time, and all of the loans that they've promised to so many businesses throughout the country, or maybe the pandemic will get significantly worse in a very short amount of time. Political instability and a surprising but negative development with the pandemic would not help the markets, since remember, they hate uncertainty. Anything that would make the markets more certain would theoretically make them more stable. And that's stable in a good way, not a bad way. Maybe it's naive to make a bottom call given the rare environment that we find ourselves in right now. You can find just as many headlines saying a bad market is coming as a good one. I've certainly been candid about my thoughts regarding real estate and the troubling things we've seen with tenants not paying rent and rents decreasing in many markets. I'll definitely include a link to one of those videos above. But in general, I think that the real estate market will see at least a slight, if not severe, dip by the end of the summer, followed by what I would think would be a healthy rebound. But I will not bet my life on that prediction, since I could be wrong and cannot control the future. Neither can you. No investor can. But maybe Goldman Sachs is right. If they are, they'll certainly earn another merit badge to add to their sash and reputation as an all-powerful investment bank. And if they don't, they'll simply join the other half of investors who thought the same. I know all of this talk about the markets and stock investing makes it obvious that you should use my affiliate links to Webull and Robinhood so you can get 3 free stocks to start your portfolios or maybe add to your existing nest egg. Check out my affiliate links in the description below to get yourselves those stocks. You can sell those stocks right after getting them and close your accounts like a true opportunist if you so desire. They're free stocks on free brokerages, so get your free money, please. I got $20 worth of stocks when I opened my Webull account, so you might as well try too. You apparently can get a stock worth up to $1,400 when you open an account with Webull, and one of up to nearly $200 with Robinhood, so you might as well take your shot. Let me know what stocks you guys get so I know if this promotion is working well. And then, when you build your $1 trillion portfolio, your predictions on the market outlook could get national headlines. Because what else are financial journalists going to talk about besides the esteemed opinions of big banks and big investors? Well, that's all I've got for today. If you liked this video, like it, since it helps the channel out a lot. If you want to see more content about investing, the markets, real estate, and other personal finance topics, be sure to subscribe so you don't miss any of my new updates. I post new videos every single week and wouldn't want you to miss out. Do you think that Goldman Sachs is right? Or did you flip a coin and land on the other side? Let me know in the comments below, but until next time, take care.